Hello YouTube and welcome back to another video. Today we're going to be talking about Bitcoin and a large scam, actually the largest we ever have for it. So what I want to look at here is going to be all the way back to 2017. We are currently resting right around those previous highs. We also have pretty elevated volume, so where Bitcoin goes from here is going to be very important. We can note that it is currently up by 6% on the week and it's looking pretty good. So let's have a look at that article and see exactly what we're talking about. Here we can note that we got the CFTC just charged a Bitcoin firm with operating the largest ever fraud involving a cryptocurrency. Right? They defrauded investors by about $1.7 billion. That's really big. And this is really important because there's a lot of things that are currently circulating in the cryptocurrency area. Notably, again, what happened with Luna, what happened with Celsius, and a few others. Also really important is what came out from Bloomberg here over the weekend. This is published on July 3rd. And what it tells us is that Tether fails to calm jittery nerves as short sellers circle. Yikes, this sounds pretty scary because this is the largest stablecoin, period. And if Tether starts to fall, what is that going to do? It is going to create a huge ripple effect through the entire Bitcoin and crypto ecosystem. So it's also important to note what the price action is actually doing on the back of this bad news. As of right now, we have an inside bar, which means that we're actually within the range from last week. And we are currently back above that 2017 high, but we are still below our 200 weekly moving average, which is going to act as very long-term support. With this red volume as well, it's not a good look at all. So I have to say that the video I was planning on recording today was that, Bitcoin had a fraud, it was going to be red, and the broader market was red. Well, what a snapback. Whoa, right? These bulls came and they marched it. We were down by 2% on QQQ and SPY, and we are up by 1.7 and 0.2 on SPY into the close here. This is incredible. So what we're going to do now is shift over here to the broader market, but let me know in the comment section, what do you think? Is that Tether article I just pulled up, does that give you concern? Are you scared about it? Or is this just more FUD? Fear, uncertainty, and doubt. So as we shift our gears to the S&P, what we can look at here is that the trend has been buy the dip since January. We reviewed this on the weekend deep dive, and what it shows us here is that in January, we saw inflows. In March, we saw inflows. In May, we saw inflows. And in June, when we had that most recent rally, we saw outflows to roughly the low that we formed in May. What does that mean for me? The May low is kind of really, really, really important. It's really, really, really important for a few reasons, notably because 10 billion is only about 1% of the year-to-date inflows. So 10% on 1 trillion is about 1%. What does that mean? If people are looking to sell and they were happy to sell up to about 380.5, we got about 100 times more selling to go through. I don't want to make the video super long, but we talked about the psychology chart before, and this is kind of what it's looking like. It's really important as well, before we look at the charts, to understand what economic data is coming out this week, because the FOMC meeting minutes are scheduled to get released tomorrow at 2 p.m. And we're now talking about a 50 basis point hike for July. And the market has repriced that. So I think it's going to be taking guidance from the Fed in terms of what they talked about at their last meeting. And note that this is coming out in the afternoon while we are trading, and it's not pre-market. We're also going to have William speaking just before the market opens at 9 a.m. And he's also speaking on Friday. So we talked about this on the weekend. I encourage you to watch it if you want to know more. Also, as we shift here too, again, we can note that we're right on track to where we were on Friday. So even though the market snapped back violently, people are not really believing it because we're still in extreme fear. Two more quick things to look at here. Then we're going to look at some charts and maybe a couple of options. So the heat map today, what I actually want to do is look at the daily chart and say, again, kudos to the bulls. Really nice day. We're seeing some nice blocks, including Meta up by 5, Google up by 4, Amazon up by 3.6. Even Tesla had some bad news over the weekend. Up, right? They had missed on Q2 deliveries. Stock doesn't seem to care today. Everything else is down. And this is really important because what I mentioned on the weekend is that we're still in bear market territory for every single individual trillion-dollar company that matters. The closest one to getting out is Apple, only down by negative 20.5. So as we start to look at the charts, what I really want to pay attention to is, are our leaders of yesterday still our leaders of tomorrow? Finally, I think there might be a trap getting set up. So we talked about how we have those Fed minutes coming out tomorrow, and the price action is very bullish. However, when we look at orders over $100,000 for options, we can note that for every one call that was bought, there was 1.7 puts that were purchased. And there's some really large orders coming through. I want to point out one here just really fast. So this is an SPX straddle. We can note that there's 12 million in calls, 15.6 million in puts, and it's for 40.75. So they are buying a 4,000 straddle, which means they think there's going to be a massive move and are betting roughly $30 million for that. All right, so with all that context out of the way, let's now look at a couple of charts. And I want to actually focus on Bitcoin for another minute just because it was actually holding up for a large part of the day. And it was actually quite interesting because there's not a lot of volume, there's negative news, but it actually went up. So that is extremely unusual. Actually, before I forget, let me just make sure I don't forget about the most important thing for the S&P here. So I want to pull back up the article or that tweet that I had with the outflows, because when we look here at let me just pull it up here really fast. Here we go. So we note here that we have a chart. The chart tells us that on the low from June up to the high of June, or roughly the May low, we saw outflows. So where does that land? That's our 380.54. That's the area we've been looking at over and over and over and over. And what do we have today? Well, we have a bullish engulfing candle. So that's pretty bullish. We also have an increase in volume, which tells us that it's kind of confirming the move. And now we have this big red line here at 383.9. So are we going to make it back above that? I don't know. But we can note that we've bounced off this lower gap 3 times now. Tested it 3 times with lower wicks. First time undecided, second time came down, ripped up. And now we have a bullish engulfing candle closing at the high. So over the weekend, we were looking for there to be follow through on Monday. We saw some pretty negative news out of Germany, and that dragged us lower pretty substantially. And there's also recession fears coming back to play. So the fact that we're able to close at the high of the day is very bullish. It's hard to argue that. Is this going to be a trap? I don't know. We'll find out tomorrow with the close. A few more things to point out here before we dive a little bit deeper is just looking across here in terms of what actually moved. We did see yield curve inversion again between the 2 and 10-year note, which means that the 2-year note, which is going to be for 2 years, you lend your money to the government for 2 years, get paid more than lending your money to the government for 10 years. Why does that matter? It matters because you're getting paid more for borrowing for a shorter duration. That is not the way it's supposed to work. If you're borrowing for longer, you should be paying more. And the reason why these are both coming down is because the Fed's likely going to break something, and they're pretty close to that area. So yield curve inversion signals a recession. And because we're noticing that, it's telling me a big message. We really have to pay attention to it. Those Fed meeting minutes coming out tomorrow are going to be very important. Again, also notable that oil took a stomp today, fell below 100. So here we're looking at CL, and this one got really hurt. So why would oil go down? Well, fears of recession. Why? If people are going to be using less and producing less, what do they need less of? Oil, energy. That makes sense. Gold is also down for risk-off appetite. And then as we look across here, trailing other companies are all fairly strong. Put-call ratios are roughly back to even here. And then there's one more ETF which really sticks out like a sore thumb here. It's ARK. It's up by 9%. That is a huge, huge move. We can note that most other ETFs are red. And finally, we're going to look over here at QQQ and note that it's up by 1.7%. That's a massive move. Why? Again, 10-year note is down. We're noticing that Cathy trade come back on. But again, is this a trap? That's what I'm really not sure of. So let's look at a couple of charts, and we'll look at the options chain briefly, and then we're going to leave it there because I think I did a good job this weekend in laying my thoughts out, and you can watch that for a deeper review. So as I'm looking here to the chart, again, what do we have? We have a green line and a red line. The green line signifies support. Red line signifies resistance. Where are we right now? Roughly in the middle. We got about 2 points lower down to 380 and about 2 points higher to about 384. So because we're closing at the high of the day, what this would assume is that there's pressure building up that should release tomorrow. That's what I would expect to see. A bullish engulfing candle is also mega bullish. All right, so now let's zoom out and look at a higher time frame here. So let's zoom over to, here we get SPY. Let's look at a 1-week chart. So the reason why this is also interesting is because if we're closing at the high and we also form a higher low, last week was 372.5. This week we got 372.9. So a roughly 40 cent higher low for the last 3 weeks now. And again, low, higher, higher, low, higher, low, high, higher, high, higher, high. What is that? That's a pattern. That's 3 weeks in a row. where we got higher lows and higher highs. So if we're able to make it all the way back up to the high of this candle, that would be a fourth one, and we're really close to actually breaking out here. If we can get back above 393 or form a new high of the week, we're going to be breaking this downtrend, which is going to be very significant. On the flip side, if we're not able to continue to go higher, and again, we know we have that big old gap here, which we've already filled, but important area. If we can't hold on to that, we're probably going to come back down and hit this 200 weekly moving average. And the date here, or where the apex forms, is really important because that is right around Labor Day. So the saying is, sell in May and go away and come back on Labor Day. So if we're able to break bullish, that would be a good start for the bulls. But on the flip side, if we do come back down here into the lower pocket, I'm also going to be paying very close attention to it. Finally, the reason why that matters is because, let me just go back to my profile here. And if you want to follow me on Twitter, I'll leave my link in the description. It's because of these. So actually, I don't have my July dates up here. So anyways, not to drag the video out, there's going to be CPI coming out. There's also going to be, actually, I think I had it there. Yeah, here we go. Sorry. So we got next week, we got CPI and earnings kicking off. And then after that, we got the FOMC. So every one of these could potentially move the market massively. And because we staged that higher low, and not everything looks all that terrible, to be honest. I think we could be headed higher. All right, now let's look at a couple more charts here. So looking at ARK, again, this chart is pretty noisy. If you've been following the channel for a while, you know that we've been talking about the psychology chart. And the area, which is so important to me, is going to be where this arrow is pointing to. It's our first key relative low after we stopped going down. So we went all the way off our slingshot, or the green line here, at about 37. And now the question is, are we able to close back above 47? If we are, what could happen? Well, we could squeeze even higher to about 60. That would be a pretty big move from where we are now. That's about another 40-50% move. And because this is the only real standout winner here, it's really important we pay attention to it. Also looking at IWM, again, what do we have here? Right? We're back above the 2018 and 2020 highs, but we are still below the 200 weekly moving average. Again, each one of these $1 trillion companies is quite strong. I reviewed all of them on the weekend video, so I'm not going to repeat myself here, but one more thing I want to look at before we go is going to be the dollar and then also the DAX. So the dollar is definitely going to be a thorn in the side of anything that is priced in dollars. What does that mean? It means stocks, it means housing, it means everything. And because the dollar is up an additional 1.4%, that means that the market closing green is actually very resilient. I would say that other currencies are weak, not that the dollar is particularly strong. And we can note that here by just going higher. If we now zoom out to a 1 month chart, we're going to note that why is there a red line right here at 106.5? Because that's a breakout going back to where? 1989. Our high is 106.66. We pierced that today, but did not close above it. So my concern is that if the market's going to keep having pressure from the dollar, well, if the dollar is going to break out like it did before, it could advance all the way up to about 125 or this next high here. That is a lot higher. It's about 15%. A 15% drop on SPY is going to correlate to about us getting down to 325. That is pretty low, and that is below the 200 weekly moving average. So that's what we got. Last thing to look at here is going to be the DAX. And the reason I'm looking at the DAX is because this is likely the market that's going to go into recession first. And looking here at the chart, it's pretty obvious. Let's actually look at a weekly one. So it looks pretty similar to the DAX. However, what it's not been able to do is to get back above and hold the 2018 and 2020 highs. What has it done instead? It's actually revisited the lows that we had, again, back when that W word started in Eastern Europe. So what does this mean? It means that we had a massive dead cat bounce, formed an M, and now it looks like it might be ready for more downside. The reason I say that is because we actually pierced the yearly low. When we look really close here, our yearly low was at 12,425, and now we hit 12,367. So when I talk about a trap, what I want to see overnight is I want to see the Europeans bid this baby up and punch it higher. We have to remember too that the dollar being weak means that dollar being strong actually means that the euro was weak and it should have been up a lot more. So if this is the low for SPY in the week, we cannot afford to revisit here. We're likely going to have contagion, and I don't know how we're going to get out of it. So again, one more time, with the Fed meeting minutes coming out tomorrow, The Europeans are going to have one final day to trade before those minutes come out. That's going to be tomorrow. And then after that, all focus is going to be on the US. If you want to know more about my weekend thoughts, I encourage you to watch the video that I'll queue up here in a moment. Otherwise, I thank you very much for watching, and I look forward to seeing you tomorrow. Thank you.